Good evening, everybody. I'm told we got a lot of stuff to talk about, so we want to get started. My name is R.D. Yant, and I have the privilege of serving on the Union League Club of Chicago's Board of Directors, and I also chair the club's Public Affairs Committee. On behalf of the officers, directors, and members of the club, I welcome you to this forum on the challenge of achieving tax reform and promoting broad economic growth, which we are pleased to co-sponsor with the University of Chicago's Becker Friedman Institute for Economics. And we are delighted to join the Institute in hosting and learning from tonight's distinguished speakers. Our partnership with the Institute is consistent with the Union League Club's mission and our history of convening community for these important conversations. Allow me to briefly explain why. We are gathered at the only private club in the nation with an institutional commitment to public policy advocacy. That commitment is tied to the club's origins, which date to the U.S. Civil War. This club arose from a movement of citizen patriots formed during the Civil War that called itself the Union Leagues of America. The purpose of the Union Leagues of America was to promote patriotism and to help President Lincoln defend the Union. That's where the Union in Union League Club's name comes from. These Union League of America chapters proliferated throughout the northern states, and at the height of the war, there were more than 1 million citizens affiliated with this movement. When the war ended, most of the Union League of America chapters disbanded. But those that were active in the Chicago area, near the birthplace of the movement, I believe Peoria, Illinois, were reluctant to dissolve their fellowship. They kept meeting in the years after the war, talking about the responsibilities of citizenship in a democracy, the need to demand responsive government, the importance of supporting those who serve the nation's military, and so on. In an effort to sustain in future generations what they considered to be these sacred values, they founded this club in 1879. Therefore, for the past 138 years, the Union League Club of Chicago has upheld these values, promoting civic engagement, good government, and service to others. And of course, civic engagement requires an educated populace and citizens who are prepared to understand the challenges of governance, to engage their elected officials, and to hold them accountable. In that spirit, we meet tonight. Again, our thanks to the Becker Friedman Institute for this opportunity and to all of you who are attending this timely forum. Now, to continue our program, please join me in welcoming Professor of Economics in the Booth School of Business and Deputy Director of the Becker Friedman Institute, Dr. Eric Hurst.
Hello, thank you for all coming tonight. I'm honored to welcome you to this event organized by the Becker Friedman Institute. We refer to it on campus as BFI, named in honor of both Gary Becker and Milton Friedman, who had long legacies with the University of Chicago. I want to start by thanking the Union League for this beautiful space and for partnering with us tonight. I'm also happy to see many of our alumni here, many of our students, many of whom are my students, and many of our faculty here as well. I would also like to take a moment to recognize a distinguished group of parliamentarians from India who are visiting us tonight. They are spending the week at the University of Chicago, and we are welcoming them here to us tonight. So let me just give you one quick second on what BFI is. So BFI was established to be a bridge across the University of Chicago's economic community, spanning both the Department of Economics, the Booth School of Business, the Harris School of Public Policy, and the University of Chicago's Law School. With over 250 PhD economists working on campus and even more scholars working on economic topics across campus, we thought the goal was to have an institute that brings these scholars together around campus to leverage the work that is being done by creating collaborations across the units. A long-standing tradition at the University of Chicago is to support inquiry and impact in all of its forms. And BFI models that approach by promoting and supporting the highest caliber of economic research, while also focusing on its translation and dissemination to policymakers, business leaders, and other interested stakeholders. And in that spirit, we are here tonight. So I think we should start with the program and get on to our discussion. And we are lucky enough to have two of the world experts on both broad economic policy and tax issues, moderated by a discussion of one of the most preeminent economic reporters in the world. So let me introduce them all to you quickly. First, we have Austan Goolsbee, a buddy of mine. He's the Robert P. Gwynne Professor of Economics in the Booth School of Business. He has previously served as the chairman of the White House Council of Economic Advisors under President Obama. He has served as the chief economist and staff director of the President Obama's Economic Recovery Advisory Board, and he currently serves as an economic advisory panel to the Federal Reserve Bank of New York. Austan's academic work focuses on many issues, government policies, the role of technology on the economy, and a lot of his work on taxes. Austan is also used to be a frequent visitor of The Daily Show with Jon Stewart. Many of you might have seen that. Very enjoyable. Eddie Lazear, not so much on The Daily Show, but still, I would say one of my intellectual inspirations and one of the preeminent economists of the last half century. Eddie is the Davies Family Professor of Economics at the Stanford Graduate School of Business. He's also the Morris Arnold and Nona Jean Cox Senior Fellow at the Hoover Institute. He is one of BFI's 6 distinguished fellows, partly for his long-standing relationship with the university during his time here as a faculty member a slight time ago. He is a former chairman of the President's Council of Economic Advisors under President George W. Bush, and his academic work has focused on many types of issues in labor economics, tax policy, productivity, and I will go further. He is the founder of the field of personnel economics within the profession. We're glad to have Eddie here tonight as well. Jim Tankersley is the tax and economics correspondent of the New York Times, former politics and policy editor for Vox, and former economic policy correspondent for the Washington Post. Jim has written extensively about the stagnation of the American middle class, the decline in economic opportunity in wide swaths of the country, and how policy changes in Washington have exacerbated those trends over time during the past few decades. Jim has a strong Chicago connection, having moved here about a decade or so ago to join the D.C. Bureau of the Chicago Tribune, where he covered Congress and the 2008 presidential campaign. I'm going to turn things over now to Jim to moderate the event. Jim.
Thanks, Eric. I think I've been waiting my whole life to be introduced by a guy who's now famous for video game papers, but sadly not on the topic of my Nintendo skills. So I apologize for that. I wish we were here to talk about all the details of the tax bill that's going to be unveiled in 2 days in Washington. I have spent the day trying to find out those details, and I'm sorry to tell you I haven't. But we promise there will be some, and we know some things about the bill, some framework things, and our 2 panelists are going to, very spiritedly, I believe, discuss those parts of the bill and the overall push for tax reform in America and how it might lift economic growth. So I want to start with Eddie, since it's a road game for you here, from California. And a very basic question that I have when thinking about writing about tax policy, which is public policy sets out to answer questions, to solve problems in the economy. What problems need solving in America right now through tax reform? What's the goal of it?
Well, I would say the major problem right now is our growth rate is way too low. And when I say way too low, that's true by historical standards. So obviously we had a very tough recession that we have come out of, but the growth rate out of the recession has been about 2%, a little over that. Now it's up to about 2.4 in the last couple of years. But that's a low rate, not only in terms of recoveries, but it's also a low rate in terms of historical standards. So if you look at the 30-year period that precedes the 2007 recession, the growth rate then was about 3.1%. That was the average throughout that period. Now it's almost a percentage point below that. And the question is, what can we do to fix that? Or is that inherently a structural problem that we can't remedy? And I think that's the thing that most of us are concerned about. The reason for that, take one more minute on this. The reason for that is this. When I think about growth, it's not just an abstract concept. Growth actually turns into productivity. It's very closely related to productivity. And there's a very close connection between productivity and wages. And that's true both in the cross-section, and what I mean in the cross-section is if you look across countries, I've done this, if you look over the past 20 years and you look at those countries that have had high productivity growth, they also have high wage growth. And it's also true if you look over time for a given country, and in particular if you look at the US or the UK, those are the ones that fit the pattern most closely. What you see is that in periods when productivity is growing most rapidly, those are also the periods when wages are growing most rapidly. So if you're asking how can we best affect the average American, working American, my argument would be growth is an essential part of that because it feeds into productivity, which then feeds into wages.
So Austan, sort of a twist on that question to you. First off, do you agree that growth is the big problem that tax policy needs to solve in America right now? And second off, if so, what sort of policy would solve it?
Look, I agree growth is critically important, and for sure over the long run is in some sense the only thing that matters. I think, the last 20 years in the United States at least have had this trend break from the multi-hundred-year pattern that productivity growth and wage growth move together. That fundamentally broke starting sometime in the 80s, maybe as you go into the 90s. And we've now gone through an extended period where we've had productivity growth and 75% of the income distributions, wages didn't really seem to go up much at all. So I hesitate buying into the premise of corporate tax cutting, which is being espoused a bit by this administration, because it's a theory, and it's a theory that says if we could just increase the rate of profit of corporations, they will pass that savings on to their workers. And I don't look at the last 25 years and see anything like that. So I think the kind of propensity to go back and let's just redo things that we just did, and people can't remember that the very same people in 2001 were arguing the very same thing, that if we were to cut rates and cut them in ways that look like they're biased toward the top or to the biggest corporations or repatriation holidays or massive expansions of various credits. The same people said that. It didn't work. And the argument about growth rates, let's say in the 1980s, leaves out the rather important part that the population growth rate, which is one component of the overall growth rate of the economy. The population growth rate was way higher at that time than it is now. Okay. And if you cancel immigration, that'll get even more. So okay, that's why.
But a quick point here is because this is a sophisticated audience that wants us to get nerdy. This is a time that we're in a moment in the economy that we haven't seen very much in the last 30 years, which is that we are at or close to full employment. Very low unemployment. Workers have theoretically a lot more bargaining power in a time like this to get wages if profits are high. Do you see this as the moment we're in as a reason to do that?
Look, in a way, I guess my question to that question is, what is the evidence that that's the case? You know, other than a period at the very end of the 1990s, as I say, we've gone through multiple waves of multiple booms in which growth, productivity, corporate profits have been very high. And unlike the period from 1820 to 1950, where that growth looks like, if you plot productivity growth and wage growth, they're right on top of each other for a long, long time. And then those things start to diverge. And until you can explain why that's happening, I think you ought to be a little careful with saying, hey, you know what we should do here? We should just up the profit and count on it going to workers. I just think that's not maybe true.
Eddie, you want to?
Oh, I wouldn't focus quite as much on the bargaining side of it. I would put it in a slightly different way. The way I would think about what Austan was saying is this, that what is true is that growth and productivity do feed into average wages, but that doesn't mean they feed into median wages, and it doesn't mean they feed into the wages at the bottom. And I think on that we probably agree. So what we've seen over the past, and it's actually not since 2000, it's actually been going on since the mid-'80s, and many people at the University of Chicago have been pioneers in really documenting this trend. We have seen a very significant increase in the disparity between the earnings of the highly educated and the less educated, and there's just no doubt that that's true. Whether it's accelerated since 2000, possibly. But I think the issue is that this is something that we need to address, and I agree with Austan, that's not something you address with tax policy. The widening of the income gap is not sensitive to tax policy. But that's really a different problem. And to my mind, that's a problem that's actually closer to my main area of interest, which is labor. And that has to do with the skills gap. I think there's very little doubt that what we've seen over time is an increase in the value of skills. We see it in all areas. You look at, everybody complains about professors being paid too much, except for Austan.
Yeah, we don't
complain. Healthcare, being too expensive. Well, why are those areas expensive? They're expensive because the main inputs in those fields are highly educated workers like us. And the return to investing in human capital has gone way up. So the question is, what do you do about that? What do you do about the bottom? What do you do about the skills gap? And I would argue that tax policy is not going to remedy that problem. That doesn't mean the tax policy for growth is not a good idea. I would think of those as completely distinct. But if we were going to talk about what we would do for the bottom, it would have very little to do with using tax policy to get that going again. I think there are many things
But
we
see,
can
there's
do
where
on that.
I think we disagree, because Eddie views these are two separate things. Here's this issue of skills, and I think that is, in my mind as well, the most important part of the growth of inequality. But I don't view those as separate for two reasons. Number one, if you have $1.5 trillion that you're willing to add to the debt to do something.
Which is the number in the framework of the Republican bill, based on the Senate and House budget that has been adopted, that the bill can add to the deficit from tax cuts. Keep going.
Okay, so let's say you have $1.5 trillion. Should you use your $1.5 trillion on cutting taxes for the very group whose incomes have been skyrocketing for 30 years relative to other groups? Or should you use it on funding college? Don't cut the financial aid provisions that the federal government is providing in order to pay for this. Use the money on this very thing if you think, as I do, that that's central to growth. I think the especially business and high income tax cuts, in my view, is a second order at best issue on the growth rate of the country. And we shouldn't spend the money on that. And then the second reason why I think they're quite related is, if you think that this trend of inequality is a problem, if you think that this bifurcation of, let's call it average and median productivity, or that average wages could be going up, but it's really because a very small group of people's incomes went way up and everyone's else are stagnant, why pile on to that trend by changing the tax code? That just doesn't make sense to me. Even if you think, as I think Eddie does, that you wouldn't use the tax code long run to try to fix the problem of inequality, why use the tax code to whatever's the opposite of fixing? Breaking? Why add to the breaking of the problem with the tax code, and that's what I feel like we're on path to do.
Well, I guess I would say two things. First, I don't think that taxes are a long-run solution to inequality. You can't use the tax system to remedy long-term inequality. You can do something in the short run to help people who are in trouble. We certainly, I think most of us believe in some kind of progressivity in the tax structure. I certainly do as well. But that's not a long-run solution. If you're thinking about how do you remedy inequality, the tax policy is just not going to get there. But Austan raised another point that I guess I disagree with. We had a love-in before. We thought we was going to, you know, this just
We didn't want to agree on everything, so we had to find.
So we decided, yeah. But the one thing I guess I would disagree on is I think the evidence actually is pretty strong on showing that tax cuts is strongly related to growth. And I'll give you a couple of examples. Again, if you go back to the literature, this goes back, say back to 2000, the one that's probably one of the best known paper is a paper in the American Economic Review by Altig, Auerbach et al. And they suggested if we went to a pure consumption tax, now the plan that we're talking about right now is not a pure consumption tax, but it's a move in that direction. Their numbers are very high, 9% increase in GDP as a result of that. That's kind of at the upper end. They're at the high end. If you look at numbers like Romer and Romer, so Christy Romer was Austan's predecessor, my successor at the Council of Economic Advisors. Their numbers in the American Economic Review, I'll read it to you, Christy and David say, an exogenous increase 1% of 1% of GDP in taxes lowers GDP by almost 3%. So this was President Obama's CEA chair as well. So, you know, obviously this is not the right speaking. If you look at there's a nice book by Berg and Henriksen. It's kind of a meta study on a bunch of tax analyses across countries. They also find growth effects. So again, I'd say that the empirical evidence on the growth effects are pretty strong. Now, where I agree with Austan is that while you get effects on growth, that doesn't mean that it necessarily translates to the lower part of the income distribution. And I certainly accept that argument. But again, I would say that the better way to do it is to focus on the skills at that end. And again, I've thought a lot about that. If you want to go into that later, we can certainly go there. But I don't want to take you off track.
No, I do want to get there eventually. But I do want to point out that this president has sold this particular tax package, to get a little more concrete, not just as an abstract growth measure, but as a way to lift the fortunes of particularly less, lower educated, working class voters who put him in office. And he has promised them this will be a huge middle class tax cut, that this will bring jobs back, this will cause investment in America, that will be manufacturing jobs. So I am curious, do either of you buy any part of that story from the president? And if so, which part?
You go ahead, Austan. You go first.
Look, no, not any part. Throw it out the window. It's a joke. That's nonsense. Even in the, look, I can give you many empirical papers. It is my contention that the evidence Eddie's citing there are some studies that claim a growth effect, and I believe that I could convince you, if you can understand regressions, I will show you that that's a small fraction of the literature. Mostly, they don't find very big effects. In theory, if you thought taxes make a big difference, they shouldn't affect the growth rate permanently. They should affect a one-time level change, but they shouldn't affect the growth rate permanently. And even if you look at papers like the Romer and Romer paper, people then go back and say, well, do different kinds of tax cuts have different impacts? And they find that tax cuts at the very top have literally zero impact on growth. So the thing that I find frustrating, I'm not surprised, but that I find frustrating with the administration, is this: let's just go back to do a thing that we've done before, we know perfectly well from the literature is not going to increase the growth rate. And they seem to have no acknowledgement of, forget about the literature, even that we've done this before. they just kind of restate, we're going to cut taxes at the top, and we're going to get magic beanstalk beans that, lead everything to come back. And I just think that I don't know what the impact will be, but I do know that for the people that were the Trump voters, this tax plan is not predominantly geared to helping that group.
Basically, anything you say now will be less critical. So,
Well, I'm responsible for my own debts only, so the president can take care of himself. What I will say is that I don't think it's a joke. I certainly don't think it's a joke because Jim Paterba, who is president of NBER, a distinguished tax economist, and I spent a year working with him designing a plan that has many similarities to the current plan. And we certainly didn't think it was a joke, and we got pretty significant effects out of that plan.
Now, what are the similarities? I know you said they're similar, but what's the similarity?
I'm going to tell you. I was just going to tell you what the main similarity is, which is the main similarity is moving to reductions in capital taxation. So, unfortunately, everybody likes reductions in personal taxation because that's what you feel, that's what affects you directly, and certainly that's what the middle-class voter is going to be thinking about. But that doesn't have the kind of long-run effects, the kind of positive effects that most people, I would say most people even in your field, Austin, think of as being the stuff that you want to do. So the primary aspect of it, of course, is to eliminate taxes or to reduce taxes on capital. How do you do that? Our plan, the one that I say is similar to the current one, had the feature of full expensing. And full expensing essentially says that businesses can deduct their investment immediately, fully, carry it forward, and even backward if you want. And what that does is it loads all of the incentives of all tax cuts on new businesses and new investment rather than on old investment. So that's why we like that stuff. That's why economists like that stuff. That's why people like Paterba and I, who I think of as not crazies, were in favor of that kind of a plan. When we scored that plan, we got very large effects. Now, when I say we personally did not score it, Treasury scored it. But Treasury, depending on the model that they used, got numbers between 2% and 6% growth for that plan. This plan, I don't know how many of you saw my piece in the Wall Street Journal on this, but I'll just kind of talk a little bit about what I said in there. Unfortunately, this plan is not quite that plan. And when I say it's not quite that plan, the biggest way in which it deviates from that plan is that we had full expensing and permanent full expensing. The one feature that I'm not crazy about in the current plan is that it's only 5 years. Now, the nice thing about 5 years is what it does is it loads growth into the first 5 years, of course, because if you know the thing's going to expire, what you're going to do is move your investment forward. The bad thing about that is that it reduces the investment that you would have in the second 5 years. And so as a result of that, that's kind of a distortion in time that you don't really want. So it's not as good as the plan, but it is a step in that direction. Now, again, coming back to, does that translate into wages? I think most people think that cuts on capital, at least initially, go to capital, go primarily to the people who are the owners of capital. Over time, that tends to change. It tends to be distributed more toward labor. And the reason for that is that capital is mobile. And it takes a while for that mobile capital to come into the United States. So if we cut taxes here, the expectation is we'll have not only more domestic investment, but we'll have more foreign investment coming in. That raises the demand for labor, particularly because labor is supplied in a pretty fixed manner. That tends to translate into wages. So I guess I don't share Austin's skepticism. I believe that at least over time, and over time might be 5 to 10 years, but at least over time you would see that translating into significant wage growth. Whether it's distributed uniformly throughout the wage distribution is another thing. And I think we're just not good enough to be able to predict those kinds of things. And I think it would be presumptuous to try to do so. But I think at least a significant fraction of it will go to the middle class.
I don't think it would be presumptuous at all in the following sense. We've gone through a 25, 30-year period where I call it either the returns to capital or the rate of profit for corporations have been epically high by historic standards. And the amount of tax that companies actually pay has been epically low by historic standards. And it hasn't translated into wages for wide parts of the distribution. Now, it might be that this was just an anomalous 30 years and you wouldn't expect that to happen again if you do with the tax code exactly the experiment that has happened in the corporate sector over the last 30 years. But I don't think it's presumptuous to ask, does it make sense to do a policy that looks a lot like the pattern that we've observed in the economy for 30 years? Now, Eddie and Jim Paterba's plan was serious. I don't think that was a joke. And I would encourage anybody who's interested in tax reform to go read it, because it's very thoughtful, not just the plan and the score, but there's a lot of discussion about the ideas of tax reform. My frustration and what I view as the joke is the crazy bastardization of tax reform ideas espoused by the Trump administration. And that is, take the example of expensing. In Eddie's plan, it's full expensing forever. And economists argue about what are the impact of investment incentives and are they big or small or whatever you think they are. That's a permanent thing. And the grow the GDP by 6% is over the forever. That's if you come back in 50 years, how much higher will GDP be because you did this? Now ask, what is Donald Trump's tax plan arguing? It's arguing, let's put that in for 5 years and then get rid of it. And let's take the numbers, assuming that it's a permanent 50, 100-year policy and how much that would grow the GDP. And let's assume that if we have a 5-year policy, we'll get all of that growth right now for 5 years and nobody will, that we won't have to essentially acknowledge that it was mostly just an accounting gimmick of what we did. And I just think that's dangerous. What the Trump people are doing is dangerous because it's through the looking glass taking findings and distorting them in a way that they know is bogus and we know is bogus and they know that we know that they know that it's bogus. And I don't see how we get out of that box.
Is it bogus, Eddie?
Well, I'm reluctant to attribute evil motives to anybody that's trying to do something to reform the tax code and make the economy better. So I don't know whether whether it is or not. That's not for me to say. Again, I'm going to stick to what I know, and I'm going to stick to the evidence that I know and the numbers that I know and the theory that I know. So let me go back to that. I think what Austan has confused again is two separate phenomena. Well, and I want to make that point because it's really important. Okay, they're two separate phenomena. When you look at rising inequality, you see rising inequality in virtually every developed country in the world. Every developed country in the world, irrespective of the tax system, irrespective of the regulatory structure, irrespective of the kinds of severance pay and arrangements that you have in labor markets. It's a pervasive phenomenon. That tells you it probably has something to do with a more fundamental issue that is not related to our deciding in 2001 or 2003 to change the tax code. And what I would go back to is the fact that unfortunately what's happened is the way technology has changed over time is that it has favored the top of the distribution. That's not a bad thing. I'm glad that we get high rates of return on our investment. We like that. The problem is that it has disadvantaged the bottom of the distribution. So if you look at a time series and you see these things going on and you say, but look, this was a period when taxes were cut as well, you know, that's just, I mean, you got 15 other things going on, so that's just a crazy inference. Sorry, I shouldn't say that, Austin.
But that's not
So,
that's not my inference.
I think it is
Look,
your inference.
well,
it is. I mean,
no,
you've
there
said
are two.
It is. You've said like 2 or 3 times.
let's
It's exactly
back up.
your inference.
It
You've
isn't.
said 2 or 3
Then
times.
let us back up
All
and
right,
play
back
the
up.
transcript.
Okay.
In which I said,
Do we have the tape?
I
Do we have
don't
the tape?
think that taxes are the main source or cause of inequality, but I don't understand why, if the trends are doing this, that you would then pass changes to the tax code that make this bigger.
Okay.
And so if you feel that it has been a persistent feature across all countries, that in the last 30 years, a very small fraction of high income, high education people get 90+% of whatever wage gains are to be gotten, why would you want to design tax policy that then says, hey, you know what let's do? Let's cut this, hope that it leads to growth, and count on the previous trend that it will translate into wages.
So here's why.
Why would
Here's
you think
why.
that?
Because there are 2 things, and again, you're confusing 2 things. Growth is important, inequality is important, but they are 2 different issues. The fact that you want to deal with inequality does not mean that you want to ignore growth. Every country that has ignored growth has done it at its peril. What I'm arguing is that we need to focus not only on inequality, which I certainly agree with you, Austin, is important, but I think I would have a different approach to focusing on inequality. I'm perfectly happy to subsidize professors. That's always great. But, but beyond that, I think that we really do need to think about that in a different way than we've thought about it historically. But it's also true that if we look around the world and we look at countries that have taken off, they have been countries that have adopted low tax, low regulatory burden, and positive market policies. And I say that, we're in the Becker Friedman Institute. I always say, when I think of Gary and Milton, I think of their great work. They're really among the greatest ever. They were not against government. They were not anarchists. They believed that government was important. They understood that you have to fund government, that you have to have a tax code, you have to have a system to fund government. But they also understood that you had to do it in a responsible way, and you wanted to do it in the most efficient way. So the thing I like about the plan, the Big Six plan, is that it moves in the direction of taking a tax system that is more distortionary and making it less distortionary. And that's its primary feature, that's its positive feature, is that it goes in the direction of a pro-growth, less distortionary kind of system. That's what I like about it, and that's what I think would be good for our economy.
Speaking of funding government, we're not funding the government to the degree to which we need for all of its outlays right now. So we're running high deficits. And one of the things we've been hearing for years from conservative economists is that those deficits pile into debt that is endangering growth. And so I am curious, the Republicans are now considering a plan that is, at least on paper, authorized to add $1.5 trillion more in debt. Do you think that the growth effects from that plan could completely pay for themselves in terms of revenues? And if not, how much do you worry about the extra debt dragging on growth?
Me or Austin?
Yeah, go. Yeah, you first, and then I'm sure Austin has a few things to say on this.
Well, I certainly agree with you. There's been kind of a switch here. Actually, it's on both sides. It's actually bipartisan. So the party of fiscal responsibility, I think of as the Republicans, are now saying, let's not worry so much about the deficit. Let's cut taxes and make things grow. And then the party that doubled the debt in 4 years is telling us we got to be fiscally responsible. So it is a switch, okay? And I would say we do have to worry about that. It's an important point. We have to worry about fiscal responsibility. But I think that first of all, let me answer your question directly. Tax cuts do not pay for themselves. I think almost everybody who looks at this believes that while you can get some of the revenue back, you rarely get all of the revenue back. Again, let me cite a study by one of our predecessors, Greg Mankiw and Weinzel, who did some pretty nice work on this. They find that for capital taxation, which we think of as the most distortionary, the worst kind of taxation in terms of growth effects, you get back about 50% of the revenue, certainly not all of it. If you tax labor, you reduce taxes on labor, you only get about 20% back, again, because that doesn't have the same kind of growth effects. So you're never going to be able to pay for itself. But the question in terms of the deficit and in terms of do we have to worry about where the economy is going and where the budget is going, there's no doubt we have to worry about it. But I would say that the overriding problem right now is not on the tax side. Unfortunately, it's on the expenditure side. And in some sense, this is rounding error. And let me give you some numbers. If you take the Congressional Budget Office's projections out 2 decades, what you will see is that, that we will be spending about 26% of GDP. Right now we're at 21, we kind of move around depending on where we are in the business cycle, but right now we're at about 21% of GDP. We'll be at about 26% of GDP, in large part because of demographics, guys like me, who you're going to have to take care of, I hope. And also, so you have Social Security, Medicare, and Medicaid. And so there's no question that we're going to be spending more. Right now, our tax take is 18% of GDP, so 18 versus 26%. So what that tells you is we will need to increase tax revenues by 40%, if we are going to get there. We're not talking about little tweaks in the tax system that's going to do that. So either we're going to have to think about the expenditure side in a different way, or we're going to have to think about the tax system in a different way, and usually that means something like a VAT. Now, there are many of us who are not in favor of going in that direction, but that's the reality. And so thinking about $1.5 trillion relative to that, while I don't want to just say, well, that's nothing, 1.5 trillion here, 1.5 trillion there, and you eventually got real money. In this case, it's going to be very small relative to where we're going to be. So I would worry about the bigger picture.
Well, then you kind of can't have it both ways, though, because the argument that this tax bill would increase the growth rate is some argument that this is significant. But then when it's like, but wait, it would increase the deficit, and doesn't the deficit have its own negative dynamic impacts on the growth rate? Then the argument is, well, 1.5 trillion isn't a very big number compared with other numbers, so therefore the debt impact negative would not be large. Those are the same numbers, so it's either large or it's not large. I think the flaw that the administration has been putting forward and the Republicans in Congress have been putting forward is this, let's look at one side and let's forget what happens on the other side. Okay, so in a lot of these dynamic scoring models, you can cut taxes and generate some economic growth, but too much debt also generates negative economic growth. And so the net impact over the long run on growth from deficit financed tax cuts is nowhere near as large as well thought through tax reform that you say is revenue neutral. Then within the corporate side, just raw cutting the corporate rate, which is what the Trump administration plan is largely proposing, is fundamentally not the same. And it's why I asked Eddie what was similar did he feel about the tax plan. Eddie and Paterba and the thoughtful economists' critique of capital taxation says if you want high bang for the buck, what you do is encourage new investment. Right. You don't go give a huge tax cut to the heirs of the Walt Disney fortune because they created stuff 75 years ago or whenever it was, that those windfalls you got to think a lot about. And just cutting the corporate rate has a very low bang for the buck in terms of growth for exactly that reason. Most of the money ends up just being a reward to stuff that was already built. And that, I think, is another example of the current proposal kind of taking a nugget of truth from the economics and spinning it into a way there's no sense in which a cut to the corporate rate of the magnitudes they're describing, in my opinion, will have the growth impacts that they're describing, because those growth impacts are premised on a totally different type of plan than what they're proposing. This thing is going to be a whole lot of windfall handouts to individual people, to individual companies, to people who are in the right sectors and what have you. And if what you care about is growth, and ultimately Eddie and I are both growth guys, I back to my thing I've said at the very beginning. If you have $1.5 trillion to increase the growth rate of the United States, you don't use it on cutting corporate tax rates for a bunch of existing C corporations or very high income pass-throughs. I think you use every cent of the money to invest in the skilled base of the workforce, to expand the economic infrastructure, or you do those kinds of things.
No, we were, until you made the last sentence, I was going to say we were almost in complete agreement. So let's just go back to right before that, okay?
Yeah, let's stick with the agreement. That's good.
So Austin's right. Certainly in the short run, and the short run might be 10 to 15 years even, there's no question that putting all the tax breaks on new investment rather than on old investment is much more pro-growth. There's just no doubt about it. And again, we scored that. When I say we, when I was CEA chair, we had Treasury score that. And if you look at $1 of tax cuts versus $1 of expensing on new investment, you get a bang for the buck of about 4 to 1 on new investment, on the expensing. So on that, we're in complete agreement. And in fact, that's kind of what I said in my Wall Street Journal piece as well, is that I think of it as on the expensing side. The only slight pushback I'd give to Austin is that the reason I favor the plan, the part of the plan that I do favor, is the part that is the full expensing side, and I do think we'll get growth from that. So while I might side with him a bit in terms of the tax cut side, in fact, the suggestion, I'm already in print, I already went public with this, I already said that I think we ought to eliminate the reduction on pass-through taxation to 25% and instead use that money to extend the full expensing and making it permanent. The only thing I would say is that in the longer run, these things are not as important. The distinctions are not as important, because in the long run, all capital is new. So if you reduce tax rates on capital, on corporations, in the long run, that is the same as reducing tax rates on only new capital. But still, I think this one would come pretty close to it.
But then I'm back to if you phase it out after 5 years, then the theoretical basis of that goes away. That's kind of my...
Yeah, well, that's what I said. I don't like the phase out after 5 years either, so we're on the same page.
All right, we're in a dangerous amount of agreement here, and we have only 5 minutes.
We've only agreed on one thing.
I know, which is dangerous. Look, I come from Washington. There is no amount of agreement that's allowed. Okay, we've got 5 minutes left till we were going to take some audience questions, and what I'd like to do is to use that to probe you both on your thoughts on a few deductions and tax breaks that folks in the audience might recognize in their own forms that may or may not be on the chopping block depending on what we see on Wednesday. So maybe some quick answers on what do you think we should do with the, for example, state and local tax deduction, which is a fairly big thing here in Illinois.
Yeah, well, I'm a Californian, so
right. Or in California.
It's even bigger for me. Personally, of course, I'd like to keep it, but I think it's a terrible idea. I think we should eliminate the deduction. There's the obvious, that talk about a distortion and an incentive for governments to pass the buck to other states. I mean, that's about as close as you come. So I don't see any reason why we should be having cross-state subsidization.
Austin?
If you're starting from scratch, we're going to all agree, let's have a very broad base and a very low rate, and maybe let's just do a consumption tax. That's totally different from saying, and when we can think about, should we lower the caps on 401k? Should we change the state and local deduction? If it's, let's do that to pay for cutting the top rate on pass-throughs, I'm totally against it. If it's, should we do one thing that economists have argued is sensible in order to pay for something which economists don't think is sensible, I think that's kind of the wrong way to look at it.
Okay, so here's perhaps a more down your alley question. Doubling the standard deduction. Are you for that or against it?
Compared to what and coupled with what? Okay, so I could see that raising the standard deduction being a perfectly viable starting point of a tax change, let's call it. And if you said we have a certain amount of money for tax cutting, do I think it'd be better raising the standard deduction or repealing the estate tax? I'd say, yeah, they should raise the standard deduction. That seems to me like it would be geared more toward people who would actually use the money, let's say, in the short run. But again, I'm back to if the raising the standard deduction, which is a tax cut, but before you can say whether you think it's a good idea or not, you got to say, well, are you talking about something would pay for it, or you're just saying, should we just nakedly do that thing in itself? It matters a lot for whether you think we should do it.
Eddie?
Well, I thought that the plan that was proposed was to raise the bottom rate from 10 to 12%, and then raise the standard deduction. And I think
And
the
get
logic,
rid of the exemptions.
Yeah, I thought the
so-
logic for that actually had to do more with tax simplification, because if you raise the standard deduction, fewer people then have to file a long form, and it was more in lines with that than it had to do with any aspect of either efficiency or pro-growth or anything like that, or even income
It may
distribution.
be right. Look, the problem they're going to face. Now let's go from the realm of the grand mountaintop of economic research to the grubby reality of what's the political problem that they face. The political problem they face is Donald Trump, through the campaign and with their quote-unquote framework, has largely outlined $5 trillion plus of tax cuts. The estate tax, high income rates, pass-through rates, full expensing, corporate rate cuts, and on down the line. They got to get to 1.5 trillion, and they got a thing that's 5 trillion. So either they got to go raise 3.5 trillion of taxes, which will not be easy because nobody's been prepped like, oh, by the way, that big cut you're going to pay for. Or they got to whittle down their 5 trillion to something that's much smaller. And therein lies their whole challenge of whether they'll be able to figure out how to do it, I think.
Well, I think we know, there's certainly been a lot of discussion about where some of the extra money is going to come from, and it's going to come from a lot of the people in this room, unfortunately for you guys. Maybe not for me,
But see, I don't think it actually will. I think they
you don't
won't.
think they're going to leave
No.
the highest rate at 39.6
Well,
at least?
To
Or
leave the
millionaires
rate where
tax?
it is doesn't raise any money.
Well, no, right. Or what about a millionaire's tax? You don't think they'll do that?
No. I think
so-
anytime, like with border adjustment tax,
Yeah.
like with the threatened we'll tax health care as if it were ordinary income, like with interest deductibility, anytime they go to raise money, I think some vocal and actually pivotal group will object, and then they'll take that out. You've already seen that on state and local. They said we're going to restrict state and local deductions. And then a whole bunch, there's 50 plus Republicans in high tax states who are like, we're totally for this, but just take that one part out.
Yeah. Well,
and they will,
let me-
because they need those 50 people.
Let me just say one thing. Austin and I, in our positions as chair of the Council of Economic Advisors, we're head of a group called Troika. And Troika is as close as the United States comes to the Soviet Union's 5-year plan. It's where you sort of get together and figure out what the growth rate is going to be in the economy over the next few years and what interest rates are going to be and so forth. And I'll tell you, Austin was terrible and I was no better at predicting this. So we're just inherently bad at doing that. But the one thing I will say is that we are a lot better at predicting those things than we are at predicting political outcomes. So I put no weight on what Austin said.
Okay, just think through my argument, though. You don't have to accept my prediction. Just look at every time they try to raise revenue, what happens. And I think that's because, unlike, take Eddie's tax effort. That was how long did you guys study It was at
Year.
least a year.
It was a year.
Yeah, it was
Yeah.
a year. In the Tax Reform Act of 1986, it was literally 3 years of grunt legwork, thinking through all the choices. What are the trade-offs that we could make? And so people were ready when it came, and it was still a close vote, but when it came to the vote on the Tax Reform Act of 86, everybody was sort of on the page of what are the possibles, and are we willing to do this in exchange for that? What's happened here is we've sold people on there's a whole bunch of free money to be had. And there isn't a whole lot of free money to be had. And so if I believe that anytime they ask somebody to pay for that free money, they choke on it. And that's why it feels to me like they're going to have a very hard time paying for the $5 trillion.
All right, so this is a good segue. I'd like to take some questions from the audience, and we'd like to take as many of them as we can. So please keep your questions short, and please identify yourself and an organization if you're with one when you ask one. So we've got some microphones passing around. Anybody want to go first?
We got one over here.
All right, we'll go up. We'll go up front. We'll take a ringer question to start.
Gidi?
Oh, okay. Go, Taryn. Go ahead.
Do you speak to the impact of capital gains preference taxes on economic growth and whether they should be continued, reduced, or increased?
Do you want to go first, Austan? Go ahead.
No, you can't.
All right. Well, so the issue is always the total tax on capital. It's not so much how you divide it up. And again, we can talk about things like expensing versus rates versus capital gains versus dividends taxations. In the short run, that makes a lot of difference because it has effects on what you do today. In the long run, the effects are primarily on the total tax rate. When we proposed, again, I apologize, I'm kind of going back to ancient history here, but when Paterba and I proposed our plan, we wanted complete elimination of capital gains taxes and dividends taxes, and at the same time, of course, elimination of all deductibility of interest payments and on the other side as well. We didn't get there. We ended up with a compromise, kind of a hybrid plan. I don't think it was so bad. It scored pretty well. So I guess my answer would be, I'd like to see reductions in capital gains taxation and dividends taxation to the extent possible. But I could live with what has been proposed now with the full expensing, especially if it were made permanent.
Okay. Go ahead.
Hello, I'm Giti Becker. Hi,
Giti.
everyone. And the question I wanted to, or the point I wanted to mention is that a bit of historical perspective might help both our speakers, because we have entered a new stage in world development. The high-tech era has started. It's changing everything and at a much faster rate than during when the Industrial Revolution happened. The Industrial Revolution, when it happened in England, the difference between wages of people, those who could enter industry and those who were still peasants, was enormous. So this is something similar to that. And I'm not really sure that, both of you have very good ideas, but the question of inequality is not something that could be solved by just spending more money, because we've seen, at least in the last, 30, 40 years, as I've watched, every time we raise more money, it goes into the coffers of the government, but our education hasn't improved. The training of, let's say, people who can go into crafts has not improved. We don't really have, let's say, people who can paint houses anymore. We rely on immigrants, even though the population has increased. So I'm not really sure, just by thinking that if we avoid giving the tax to the rich, it's going to help the people who are unemployed or who suffer from greater inequality. I think it sounds very good, but will it really happen? I think we need to maybe think more seriously about how to solve some of these fundamental problems of our economy. Thank you.
Okay, so thank you for that. I think that a way to riff on that would be just to say very quickly, what do you think would be the right solution here for inequality? We talked a lot about tax policy not being the solution that you thought. What do you guys think?
Look,
go
my
first,
thing, I'm not, my concern is not so much the fact that there's inequality. It's that there's a large chunk, maybe the majority of the workforce, whose standard of living does not seem to be progressing very much. I hear the critique that, you know, what if the government wastes the money, or would it actually work? But I will observe, if you get an associate's degree at community college, or you look at any people who have any form of post-secondary degree, the unemployment rate is in the 2s for them. So I think actually if you can, anything you do that gets people to get some extra schooling, I do actually think it works. I think the evidence is really quite overwhelming that in some sense the greatest jobs program that exists is to get somebody to complete the associate's degree that they started at community college. So I kind of think that I always go back to that as a starting point, and I actually think probably most economists agree that something on the skill base is the place to start.
Yeah, on this one we're not far apart. Coming back to your question, though, Gidi, and let me pick up on what Austan said as well. Technology by itself is not a bad thing, it's a good thing. Okay, we're a lot richer today than we were in the 19th century. We work many fewer hours, we have much higher standards of living, and most of the 20th century did not throw people out of work. In fact, we saw the opposite. People came into the labor force in higher numbers. So the question is whether things like artificial intelligence and all the things that you're talking about, all the new developments, will follow that pattern, or whether there'll be a break and whether something else will happen. And in particular, whether it will be a break that disadvantages a large part of the population. So one of the things that I have looked at, I was going to pitch this earlier, but since you raised it now, I'll talk about it a little bit. One of the things that I have looked at a lot is different structures of education, in particular vocational training. And when people think of vocational training, they're usually thinking of, you know, guys learning to be plumbers or carpenters, things like that. That's not the right way to think about it. Vocational training in Europe, and particularly in the German-speaking countries, Germany, Austria, and Switzerland, is primarily providing skills in school that are useful in the labor market. What we tend to do in the United States is, if you're not on an academic track, what you get is a watered-down academic track rather than skills that are going to be useful. So I ran into some kids in Europe. I happened to be, you know, I was actually on a ski lift, and I was riding up with these guys, and they were not supposed to be on vacation. And I said, "Why are you guys here? I always ski when you're actually in school." And they said, "Oh, because we're in this vocational training program." And I said, "Well, what are you doing?" And they said, "Well, we're training to be physicist assistants." And they were taking calculus, and they were taking, you know, physics and engineering and so forth, and that was part of the vocational training program. Now, that was at the top end, of course, but the point is that what they were doing was giving kids skills that were useful. If you look at the data, and if you compare the German wage distribution to our wage distribution, what you see is that people who have vocational skills earn 90% of the average. In the United States, our high school graduates, let alone the high school dropouts, earn only 70%. And I would argue that a large part of that has to do with the skill formation over there.
All right, I think we have time for maybe one more. So yeah, go ahead. Karen, do you have something back there?
I'm Sukumar. I'm an alumni of Booth School. So I would like both of your views on the main point they were selling initially, at least, is that when they reduce the tax rate or change the tax structure, a lot of money will come back that the corporations are holding abroad. And no, that has not been touched. So maybe, you know, just give your views on that.
Yeah. Okay, you want me to start on that?
Yeah, sure.
I think there are two aspects to a lot of money coming back from abroad. One is the repatriation issue. So that's one that people talk about a lot. While money would be repatriated, my sense, and again, this is based on evidence that we put together when I was at Council of Economic Advisors, is that repatriation does not have a major effect on investment. And the reason is, this is not a country that's particularly capital starved. We have very thick capital markets right now. Only if you're capital starved is bringing money back over going to immediately translate into additional investment. So I think that's, that doesn't mean we shouldn't do it, but it's not a reason to be thinking about that. What I would say is in the longer run, capital flows do respond to different tax rates in different countries. It's obvious if you look at countries like Ireland that had a huge growth as a result of that. And so I would say that if you're thinking about the longer run, rather than just the repatriation aspect, lower tax rates will be beneficial to bringing forward capital in.
Austin?
Yeah, look, we went through this, and the CEA looked at it, and other researchers at the NBR have looked at. We did this once before on the premise that if we give a holiday, they'll bring the money back, and we'll get a lot of investment, and it will work out great. And literally 95% of the money was brought back and paid out in a dividend, because a different way to say it is there's a little over $2 trillion, if you look at the flow of funds data, on corporate balance sheets not being used. And about half of that is overseas, but there's about $1 trillion sitting on balance sheets in the US not being used. So you can give a tax cut and get them to move it here, but then the people will be saying, why are there $2 trillion on the balance sheet not being used in the US? I think it's, it goes back to the investment incentive.
Okay, I'd like to take this moment now to thank Jim, Eddie, and Austin for a very lively debate.
Thanks, guys. Good job, Austin.
Yeah.